Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap with Lance Roberts. Hey, Lance, how you doing?
I'm fantastic. It's Friday. Could be better.
Good. Well, you look a little more bright-eyed and bushy-tailed than you have over the past couple of weeks where we had that intense volatility. But there's an awful lot to talk about today. Yeah. I want to dive right into the market action with you. But real quickly before we do, I want to let folks know that we're going to be talking as well in this discussion about what I've heard from your fellow who's on the front line there, talking to the folks that we refer over as really the number one concern that the people he's talking to have. And you and I chatted a little bit before. Yeah. Sounds like you've got a pretty good explanation to it. So folks, stick around for that, especially if you're holding on to a lot of cash right now in your portfolio. All right, Lance, as we look back on this past week, what's the theme of the week for you?
Inverted yield curve. That has been everywhere over the last week or so. In fact, it kind of leads into my article I have out on our website today. As a matter of fact, if you go to realinvestmentadvice.com, I have an article talking about inverted yield curves. And I said, the opening paragraph is, so many people are now talking about inverted yield curves. It's almost like a bad joke. An inverted yield curve walks into a bar. The bartender says, "Hey, what's got you down?"
Oh, it's such a finance dad joke.
No, it is. But that's kind of the point. I mean, it's there's so many people talking about it. It's like, oh, the yield curve inverted by 1/10 of 1 bip today, and that means a recession's imminent. No, that's not what that means. And let's talk about yield curves and what it means. And importantly, that it's not one yield curve that matters. It's all of them that matters the most. So very quickly, yes, the yield curve inverted. Does that mean a recession is imminent? No. Does that mean that yield curves have they do have a perfect track record of predicting recessions? That is a true statement. But that doesn't mean that you're in a recession now or about to be in a recession next week just because the yield curve inverted. What does that mean? All a yield curve means is that when it inverts, and we talked about this before in the show, is that it just means there's something wrong economically, and the economy is in a very fragile state. So just imagine that you're standing on the edge of a cliff and you're looking over the edge of the cliff. That's the inverted yield curve. Now, as long as nothing comes along that gives you a little gentle shove, you're okay. But what the yield curve says when it's inverted, all it means is that the economy is ripe for a recession if it is impacted by some exogenous, unexpected event. Let me give you a great example of this. 2019, we were writing about the inverted yield curve. We said, hey, yield curve's inverted. The media immediately started talking about, oh, recession's imminent. But what happened is that over the next month or so, because a recession didn't occur right away, the media started saying, oh, well, it's different this time. It wasn't different this time. In the midst of that whole process from August of 2019 through December, the yield curve was inverted. The Fed was in the background bailing out hedge funds through reverse repo operations, but everything seemed to be okay. Markets are going up. It's all fine. Media is saying, hey, everything's fine. Yield curve is wrong. The perfect indicator has finally failed. And then March of 2020, we're in a recession. Now, did the yield curve and the bond market know that we were going to shut down the economy because of the pandemic? No, the bond market didn't know that. But what the bond market did know, and what the bond market was sniffing out, was that there was a problem, and this is why we were bailing out hedge funds, that there was a problem that existed, and all it took was some exogenous event to push the economy into a recession over the cliff. So that's all this is telling you. When you see the yield curve invert, that does not mean to go put all your money into cash because we're going to be in a recession tomorrow. In fact, you may regret doing that because some of the best rallies in the market occur while you're in the inversion. Now, as we talked about, I think last week, Adam, if I'm not mistaken, last week on the show, we said when it matters is when the yield curve uninverts, and not just one. And what we need to see is we need to see numerous yield curves invert. That's the warning, right? When you have multiple yield curves inverting, both short and long. So when you have these multiple yield curves inverting, that's telling you there's a real problem. And when those yield curves uninvert, that's when you're in recession. And about 6 months later, the National Bureau of Economic Research will tell you, oh yeah, the recession, it started when those yield curves uninverted.
Yeah, now that you're lying on the ground with your legs broken, there was a bus heading your way about a minute ago.
Yeah, exactly.
Yeah.
It's better late than never, right?
Yeah. So great explanation. A couple of things. One, the main reason we're talking about yield curves yet again this week is because the 2-10s yield curve inverted. And that's the one, for whatever reason, the media spends most of its focus on. As we've been saying for weeks on this program, many other yield curves have already inverted. And that's what you're saying is, hey, when we have a whole bunch inverting, we really need to pay attention. To your point, the inversion doesn't mean that a recession's coming tomorrow. And I went and looked at kind of the historical data, and it shows that the average sort of lag between inversion and the declaration of a recession is about 1 to 2 years on average, right? And as you said,
be careful with averages, though.
Oh, absolutely.
Yeah.
And I'll let you comment on that for a second. But two things. One is, as you've said, hey, it's not so much it's when the curve inverts that you got to watch out for or start worrying. It's when the curve uninverts, right? So we don't know how long it's going to take. And as you said, within the inversion, sometimes there's some phenomenal rallies here, right? So you don't necessarily want to dive into your bunker right when this thing first inverts. Also, and you can comment here about the average part, but there's a lot going on macro-wise here. So if we are indeed heading towards recession, if the Fed sticks to its rate hike schedule here, that could be a factor that could pull things in. So all I'm saying is there are different factors in play that again, I mentioned an average, but that those goalposts can be moved a lot by some of these other factors going on.
Adam, you're absolutely right. When we're talking about, averages, though, I want you to be really careful with averages, because there are a couple of periods that were extremely long in that data set. So when you're averaging something, if you got, a bunch of 3-month windows as an example, then you've got one down here that's 36 months, it makes the whole averages look a lot longer than they really are. But my point is, and you can kind of even see it in this table, is that there are periods of time where that average is a lot shorter than 12 to 24 months. And it doesn't mean that this time is going to be that much shorter as well. But specifically to your point, I hate using these words, this time is different, but there are some things that are different this time than what we've had over the last decade, at least anyway, because we now have all this monetary policy is now reversing. So that's monetary tightening. At the same time, we've got high inflation. That's monetary tightening. You have much higher interest rates. The 30-year mortgage rate for houses is now up to 5%. That's monetary tightening. So we have a tremendous amount of monetary tightening that's happening naturally within the system. And now the Fed is going to tighten that even more. Right now, it's estimated there'll be 3 50 basis point rate hikes over the next 3 meetings, and then 25 basis point rate hikes after that going into 2023. So you're talking about nearly a 3% Fed funds rate. I'm going to tell you right now, we ain't ever getting there, but that's what the market's predicting. And then they're also going to start tapering their balance sheet on top of that. Now, the last time the Fed was hiking rates, when they started tapering their balance sheet, over the course of about the next 4 months, we were in a 20% decline in the market, and the Fed was completely reversing course. So the point I'm making is, and to what you were saying, is that, the normal average from time to inversion to recession typically lasts 12 to 24 months. This time it could be a little bit shorter, maybe 9 to 12 months, maybe 6 to 12 months, because of all this extraordinary monetary tightening that we have going on. If we were operating in a vacuum and it was only the Fed tightening policy, 12 to 24 months sounds completely logical. But because we have this other stuff that's going on, it could be a lot shorter.
All right, great. And the last question on this, you gave a great analogy here of the risk curve inverting is like stepping up to the edge of the cliff, but it doesn't necessarily mean all the bad stuff's going to happen, but it means that you're more vulnerable to that shove, right, from some other factor. Is it possible for the exogenous factor to cause the risk curve inversion? So in other words, could we say that, hey, all the input costs issues that are now being created by the global embargo against Russia and some of the geopolitical, or at least geopolitical trade, reshuffling of the board here. Could that be an example of a black swan that actually causes the curve to invert, and then the repercussions after that?
You're not incorrect in what you're saying. The problem is the market is already aware of this. So we already have high oil prices. We already have inflationary spikes in commodity prices. The market's been pricing this in over the last couple of months. And that's why, over the last three weeks or so, and, a couple of weeks ago, you and I were talking about market was extremely oversold. It was, extremely negative, very pessimistic. We talked about adding growth stocks to our portfolio, which we actually sold those positions on Monday. But the market was ripe for this kind of quarter end rebalancing rally that we had. And that's the market. Look, and the markets are down at the most 12% this year on the S&P. Now it's a little bit more on the NASDAQ, but on the S&P down about 12% this year. So the markets have been pricing in a lot of this, Russia, Ukraine, higher inflationary prices. And I'm not saying they've priced in everything, but they're pricing, the market has a really good propensity to price in things that it knows. Now, here's the important thing. Just because it's priced it in because, hey, I'm aware of that issue, what that becomes is that's like kindling. And this, kind of talking about the yield curve again, if I had a big pile of wood and I pour gasoline on it, right? I've got everything necessary for a really good fire. I need a match though to make it work. It just won't ignite by itself. So think about, high inflationary pressures, high commodity costs, all these type of things. That's the kindling and the gasoline. I mean, we've got a really great environment for a sharp recession, a big sell-off in stocks as earnings estimates get repriced very quickly, valuations get repriced. But again, you still need something now that crops up that the market is not aware of. And usually, normally, what creates that environment is some type of credit-related event, right? So sometimes, the leverage loan market runs into a problem because of higher rates, and all of a sudden companies can't refinance leverage loans, or the high yield market cracks because of, higher interest rates. And look, we have a lot of zombie companies in the small mid-cap space that are dependent on debt in order just to stay alive. And all of a sudden you start getting bankruptcies that are piling up. That's the thing where the market steps back and goes, oh crap, I wasn't anticipating that. Now I've got to reprice everything I was thinking about at a much lower level. And because of the lack of liquidity, that's where we get these sharp sell-offs.
Okay, yeah, great. So curious on that point, we are beginning to see rates and yields rise here. I mean, not just what the Fed's doing, but you mentioned mortgage rates. I think like last August, they were like 3.4% on average or so, and now we're close to 5%. The 10-year, has moved a lot in the past month. I'm just curious, how worried are you about the trajectory we are in terms of the rising rates, that we might start getting close to something that could trigger some of these credit problems by a lot of these over-leveraged players?
We're pretty much there. What I mean by that is if you go back in history, and I wrote an article on our website just earlier this week talking about why now is the time to start buying bonds, is we are at a point in terms of rate increases, right? So bond interest rates have been going up. And we're at the point historically, and this is not historically over the last year or two, this is historically over the last 50 years, that when we've been this overbought on interest rates, or consequently this oversold on bonds, this has been a prime buying opportunity for owning treasury debt. Why has it always been a prime opportunity for owning treasury debt at these levels? Is because at this level is where you break something in a debt leveraged economy. And again, this is the key point. I want to go back to what we're saying earlier, talking about this match that lights the gasoline. I don't know what it is. You don't know. I don't know. That's why it's unexpected and exogenous. And, this is the thing that shows up, and you and I are going to wake up one Monday morning and go, oh crap, we need to do something now. And it will start kind of running through the markets when this occurs, and it'll be Deutsche Bank failing. It'll be something, but I can almost guarantee you and with not with 100% certainty, but historically it's normally credit. And the reason that it's credit is because credit is the lifeblood of the economy. It's everywhere. I mean, house debt, mortgage debt, corporate debt. I mean, you name it. We're leveraged to the hilt. Margin debt, across the board for retail investors at, near record levels, So normally what cracks the economy, sends the Fed into a panic, we have to start bailing out all the banks again because, they're healthy and they've got plenty of cash flow and they pass all their stress tests. But when we get the next downturn, we'll have to bail the mafia out again. That will be that event that we weren't expecting. And I don't have any idea what it is, what it could be. I've got no crystal ball, but I do know that that's probably what's going to happen.
All right, great. And just to kind of murder the analogy about our massive barbecue that's filled with kerosene here, is the match hasn't necessarily been, we don't know what that match is yet, but the higher that these rates and yields go, the more guys that are wandering around our fire pit, smoking cigarettes who aren't paying attention, right?
Exactly.
All right. Well, let's get to the week. So last time we talked about the big rally that the markets have had. You referenced that a little bit earlier. And from what I briefly saw this week is the markets closed up for the week, but not all that much. But it was kind of like a big curve, right? Where the markets rose up in the midweek, but then have sort of been cooling off since. Yep. So we've been talking a lot about, okay, is this a bear market rally? You have said it is a bear market rally until it proves otherwise. If you can talk about whether you think maybe we're at the tail end of this thing here, and maybe we can then kind of go into some of your trades as well, because I've noticed looking at your trade alerts that it looks like you've been more in a sell mode of a lot of kind of regular long positions than normal.
Yeah. So two things. One, I hate to keep plugging the website, but I wrote an article on this on Tuesday.
Plug away.
So on our website, BillInvestmentAdvice.com, I wrote an article on Tuesday called Bear Squeeze. And it's easy to find. It's two fingers squishing a gummy bear. And it's one of the good gummy bears, if you know what I mean. And we're going to get to that conversation in a minute. Anyway, the point here is that, we were talking about, we have to go back now a little bit in our conversations, Adam, 3 weeks ago. Super negative sentiment, very light positioning by, hedge funds, mutual funds, et cetera. And we were talking about quarter end rebalancing and that it was very likely we would see a rally because of this quarter end rebalancing. Because when you have, the equity sell-off that we had in conjunction with the sharp spike in interest rates, which led to the biggest bond market sell-off we've had since like 1932, any 60-40, 80-20, 70-30, 90-10 allocation model was out of whack. Their equities were below target levels, their bonds were below target levels. So all that had to get bought back up for end of quarter for reporting purposes, because most mutual funds can't carry more than 5% cash at the end of a quarter. So they had to get bought up to markets. And so that led to this 2-week rally that we've had. And again, you're right. This week, we started out very strong and kind of tailed off here at the end of the week, but it's actually been a 2-week rally that was 10%. It was a very, very large rally from a historical standpoint. Now, the reason that this is likely a bear market squeeze is that you don't see you don't see a 10% rally over 2 weeks in a bull market. You see that as part of a short covering reflexive rally in a correcting or a more bearish trending market. And that's what we have going on right now. So, it's not surprising. And I wrote about this on, Monday, Tuesday. If you read our daily commentary, every day I put in on our daily commentary, a market trading chart. And I say, this is where we are. This is kind of what we're expecting. And on Monday, Tuesday, I said, markets are very overbought here. We're 2 standard deviations above the 50-day moving average. I know lots of mumbo jumbo technical stuff. Just hang with me for a second. All that means is that we had gone from that exact same setup on the downside when back near the Russia lows, 3 weeks ago, we were 2 standard deviations below the 50-day moving average. And what that means in technical terms. So I'm going to explain this for you in very simple terms. Physics says that if I take a rubber band and I stretch it as far as I can in one direction and I let it go, physics says that rubber band will travel an equal distance in the opposite direction before snapping back to the middle. So that's all Bollinger Bands are. Bollinger Band said, hey, I was 2 standard deviations below the 50-day Now I'm 2 standard deviations above. That's that reflexive snap. And so now the market's pulling back down. So we're at a very critical juncture for the markets as we go into the weekend. We're sitting just above the 200-day moving average, which is just above the 50-day moving average. So there's some good support right here where the market's sitting. If the market is able to hold this kind of support level, work off some of this overbought condition without cracking that support, there's a reasonable possibility this market could rally back to all-time highs in April. April seasonally tends to be a fairly strong month. But Lance, there's an inverted yield curve. We're about to have a recession. I get it, right? But I'm just telling you that statistically, April tends to be a fairly strong month. There's still a bullish bias to the markets. Don't discount that entirely, by hiding in cash or being, and again, we talk about one-sided trades often here. We have to always play the probabilities of the markets and understand the possibilities. And this is incredibly important about managing money. We always manage towards probabilities. We pay attention to possibilities. And that's a very big distinction. So right now, if the markets break that support at the 50-200 day, we're going to go back down to lows. So we start breaking those support levels, we're going to raise more cash and come back down to lows. So now Adam just said something very important, is like, we've actually been selling this week. And, 2 weeks ago, when we were near the lows, we talked about here on the show that we were buying some of our favorite growth stocks because they were really beaten up: Apple, Microsoft, Nvidia, AMD. On Monday, we had added to those positions a couple of weeks ago, had this huge rally, much bigger than I expected. So we took those positions and took them back down to model weights. So now we didn't sell everything. We still own them, right? We just own less of them.
This is the position sizing that you talked about last week.
Exactly. So we had overweighted our position size. Now we're back down to model weights, which are slightly underweight position sizes. Now, that doesn't mean, again, that we won't buy those shares back. If we work off this overbought condition in the next couple of weeks, hold support, we're going to go right back into buying those positions again and take the next leg higher until we get into a sustainable trend. And that's the key word, a sustainable trend in one direction. Right now, we have no trend in the market. So we're having to trade more because the markets are just going up and down sideways. Once the market decides which way it wants to go, up or down, then we'll manage for that trend at that point, which will be longer term positions. We also sold our financials today, because one of our financials, because JP Morgan, to be clear, they're the mafia. So we sold them only because they're getting impacted by, rising rates and inverting yield curves and those type of things. So we took that out of the portfolio. We also bought bonds late Friday last week, adding to our bond portfolio as well. And bonds have been performing fairly well this week.
Okay, great. One thing I want to mention, you mentioned how the 200 daily moving average, the 550 day are pretty close here. And it's kind of a important moment for the market here, right? It's either going to find support, and if it does, if it can work off the overbought conditions, you feel like, okay, then it can make a next leg up. You and I think, can come up with a long list of sort of negative reasons why it might break through support. But I want to point to a positive one here for a second, which is there's a wild card out there about truce in Ukraine, right? And I would presume, and I want to get your reaction to, as it's sitting there, determining whether or not it's going to find support or not, I would imagine if a favorable truce was declared in Ukraine, we would still see a big pop in the market. Could that be, a catalyst that sends us up to new highs from here?
So, and I try to do this, and I'm actually writing this in our newsletter this weekend, because I'm talking about April statistics versus, the market. You and I can come up with a pretty long list of bearish reasons right now why you should pretty much be in cash, right? I mean, the economy's slowing down, we're going to have a recession at some point, yada, yada. Why am I invested in stocks? But there is a bullish ledger to this. And, when we talk about this, look, corporate stock buybacks are still a huge support for the markets. And we're in a blackout window here for the next couple of weeks. But as soon as we get past the blackout window for buybacks, that buying support for stocks is going to come right back in, because that's what corporations are doing right now. And again, we talked about the evils of buybacks. That's a different don't get me on my rant. But that is a real legitimate support for the markets. They have been a major buying support for the markets. In fact, you can pretty much make the case that they have been 100% of the net buyers of asset prices or of assets over the last couple of years. They are buying billions upon billions of dollars worth of stock in the market. And that's why, a lot of these stocks have not gotten hit nearly as much as other companies have. But that's a bullish support. Other support is that, we still have a tremendous amount of global inflows coming into the United States. Where else are you going to invest money in the world, right? I mean, are you going to put it in emerging markets or international? Those countries have been lagging the S&P for the last 10 years. You want to keep buying lagging assets and have a diversified portfolio of stuff that's underperforming, be my guest. But that's why everybody else is putting their money into the US as well, because you have rule of law, you've got safety of liquidity, and you have better performing assets and higher dividend yields in the United States. So money's flowing in. So, there's a lot of reasons that this bull market does what it does best, which is frustrate bearish. And look, I typically lean a bit bearish because I'm conservative with money, but you've got to be careful being super bearish, because if you think the end of the world is coming, you're going to invest that way. And this market has a really good propensity to really mess you up. It'll drag you right back into the market, and then it'll cut your feet out from under you. So that's why it's important to understand what market dynamics are doing and just follow the market. Let the market tell you how to invest. There will be a point the market will be clear that you need to be in cash and bonds. We're not there yet.
All right, and that's a perfect segue to talking about, the main topic that I mentioned at the beginning of the video here. They say that bull markets climb a wall of worry, and there's a lot to be worried about, and there has been, right? But for the past bunch of years, that bull has kept climbing, right? And there's a lot of people who 2 years ago, 5 years ago, 10 years ago, in a number of cases, were so worried they moved to cash and then stayed there. Because at any point along the way, they looked at the current macro environment and said, all right, should I put my cash back in the market? Man, there's just even more stuff to be worried about now. The debt's higher, right? There's more instability in these areas. Boy, I felt nervous enough to take my cash out a few years back, but I think it's even worse now. So I guess I have to stay in cash. And they've just stayed in cash while watching the market go higher and higher and higher and higher, right? So I know a lot of people are contacting you and the guys at New Harbor saying, all right, look, I'm at the point where I'm willing to let an advisor who gets all this stuff, like Lance, manage some of my money. But tell me, if I give you my pile of cash that I feel like I'm kind of stuck in, how do you address the fear I have that you're going to put it all in the market and then the market's going to crash the next day, and I was the last greatest fool to get involved before the whole house of cards coming down that I was fearing actually happened?
Yeah. So look, this is a key thing that we work on all the time. And I have this conversation literally every day. It's what internally we call our onboarding process. How do we take an account, no matter what you're invested? Let's say you're invested in a whole bunch of stuff that you bought, and you now want to, have us do it for you, and you want to be in our model. That's how do I transition you from all cash or your current holdings into our models? That's what we call an onboarding process. So it's really easy, Adam. We put everything in Tesla, and then we just kind of see where we go. I'm joking.
Yeah. But the Tesla calls, obviously, right?
Exactly. Tesla. Yeah, obviously Tesla calls. I mean, duh.
Maybe a little, AME and GameStop sprinkled in.
Correct. I mean, you have some risk management in there. I mean, you can
diversification, right? Exactly.
Exactly. I'm joking. I am totally joking. I just want to be really clear. Total joke. Okay, look, onboarding, and this is the way we approach things. So we've got it doesn't matter what your account is. Let's just, for the sake of argument, Adam's account, it's 100% cash. And our portfolio right now is 50% stocks, it's 30% cash, and the rest of it's bonds and bond funds and cash alternatives. So how do we get you from all cash into our model? We don't buy it all at once. And this is one thing that's always bothered me about the industry, and particularly with this whole buy and hold passive indexing strategy. You open up an account with an advisor the next day to say, hey, well, you're just going to buy and hold. You're in this for the long term, right? So you throw all your money in the markets. The next day, boom, you're allocated into everything. And typically that happens right about the top of the market, and you wind up losing a bunch of capital. That's a horrible way to invest money. So the process that we use is unfortunately, it's a slow process. There's no way to do this quickly unless you just happen to show up right at the bottom of a big correction. Then we can go all in pretty quick, right? That makes things much simpler. But if you were coming in today, look, I've just talked about the markets being very overbought a second ago. Let me give you an example. I have a client right now, all cash, starting to onboard the process. So what are we buying? Well, right now, bonds are extremely oversold. As we talked about earlier, bonds have had a major bear market. So we're starting to buy the bond portion of the portfolio. Now, again, we're not buying all of it. We're starting to nibble into it. So we do this in stages. So let's say we talked about risk sizing previously. So let's say that we want to own 5% of some stock, right? So we might buy 1% of it today. If the market continues to kind of heal up and starting to perform better, we'll go ahead and buy the 2%, the 3%, and we'll build into that position over time. Say you've got 15 stocks in the portfolio, same process kind of happens across the board. But right now, the markets are overbought. So we're not buying any equity at the moment. We're going to wait for the market to pull back here. We've had a couple of days of correction. This is good, kind of giving us that opportunity. If markets can hold support here for a few days, work off this overbought condition, yeah, now we'll come in and start buying a little bit of the equity exposure. Over the course of the next 6-8 months, the markets are going to go up and they're going to go down. And when things are going up and down, then we're going to be using those dips to slowly build into that allocation, getting your cash put to work, buying the fixed income, buying precious metals, whatever it is that we need to own for your portfolio. We'll slowly get that built in opportunistically. There's no need to run into markets, literally overnight, because that's just setting you up for failure at some point. Look, the whole thing about investing, and if you just think about investing this one way, it'll help you resolve a lot of things. Investing is about opportunity. And if Adam came to you and said, hey, you know what? I'm willing to sell you my house at a 60% discount because I want to move out of California. I want to go move to Texas, right? You'd probably buy his house, right? I mean, 60% off. Yeah, I'll buy his house. That's an opportunity. And so I've got cash. I'm going to put that to work. And that's all investing is we're looking for opportunities where the risk and reward are in our favor, and we'll put that cash to work. If there's not an opportunity to put cash to work, we'll sit in cash because cash is a safe hedge. I don't have to worry about losing capital in that manner. Does that make sense?
Well, absolutely. And you have the optionality of the cash, which you just mentioned earlier, but that's becoming, I think, even more important in a macro environment like this, where there may be a lot of reasons why, there could be a much better buying opportunity ahead, whether it's in a couple of months or in a year or whatever, but preserving that dry powder and having the ability to get out there with it when better valuations are around, that can make a huge difference in somebody's long-term portfolio returns. I'm glad you went through all that, Lance, because I've heard from talked to a lot of people, as you said, know that this is a very dominant concern a lot of folks have, but it's amazing and really just, kind of soul crushing to hear as many horror stories as I've heard from people who've said, yeah, I went to firm X and, they just kind of opened up my account and they just sort of threw me into the market. And then, the market was down 8%, over the next month or two. And I found that I was just like immediately in the hole. Right. And I think for the type of prudent, and I'm going to say somewhat, financially conservative person who watches this show, I totally understand why that's a big fear. And again, I hear from a lot of people that they're just, they just want to find somebody who can give them some comfort that, we're just not going to put you at maximum vulnerability here. So anyways, I think you just did a really good job of articulating a strategy that somebody, whether they want to do it themselves or whether work with somebody like you, can take.
Yeah. Let me say one thing about this too, because this kind of inures to our overall strategy. And when, just because we're going to try to buy opportunistically doesn't mean we're always going to get it 100% right. And this is why we buy small positions and stuff. We'll buy half a position. And then, if we're a little bit early and the price goes down some more, we'll buy some more of it, right? And we'll work our way into the position. But that really goes to, I'm writing an article on this here in the next, week or so, talking about our 80-20 strategy, which the goal is that when markets are declining, there's that 10% just before I get to the ultimate bottom, and there's the 10% coming out of the bottom. Right. So, I get in, I'm 10% too early. The market goes down another 10%, but there's the ultimate bottom. A good example of that was December of 2008. And then you had another 22% January and February before you got to the March bottom. Right. So, so our goal is to try to come into an opportunity. We might be a little early, right? We might be right on time. We might be a little late, right? Buying it, coming out of the bottom. But what we're trying to get is that 80% in the middle to the next top, right? And then, of course, when we get to that next top, we might be 10% too early getting out. We might be right on time, might nail the peak on getting out, right? We might get lucky. And we might be 10% too late getting out. But the goal is to avoid that 80% on the other side, on the downside as well. And then that's really kind of the process of slowly working in, and you described it well, and I talked to a lot of people that, since 2009, they've been out of the market in cash because the market ran up. They go, okay, well, I'll wait for a correction and then I'll get in. And then the market keeps going up. Well, now it's too overvalued. I can't buy in now. It's overvalued. I have to wait for the next bear market. And the next bear market hasn't come. And then when you had a bear market or an opportunity, the market's down 35% in March of 2020. Oh, well, hell, now it's going to zero. It's all over, game over. Then the market runs up 120%. That's that psychology that gets all of us. It gets me, it gets Adam, it gets everybody, and the important thing that we have to do as portfolio managers is do exactly what makes us sick to our stomach doing sometimes. And, that's buying stuff that is really out of favor, that everybody hates and has risk of going lower. Buying bonds is not easy here because it is simply a decision that we're looking at technically and statistically and financially, going back through history, going, every time we've been here, this has been the bottom of the bear market, but this feels like a terrible time to be buying them. It just doesn't feel right. And if we're wrong, we've got stop losses, we'll get out. But we feel pretty good about our position right now. And we're going to continue to kind of build on that as we kind of go forward. But sometimes these positionings take months to play out. So it's important that we have some type of strategy for managing those risks in the meantime.
Great. And you're just hammering home all the reasons why, we are here at Wealthion, just keep hammering unless you're an experienced investor yourself, work with a professional financial advisor who can take the emotion out of it, because like you said, and come up with a rational plan and execute against it. Because otherwise emotions drive you, and the whole, Warren Buffett, it sounds great, be fearful when everybody's greedy and greedy when everybody's fearful. But I'll tell you, it is super hard to be greedy when everybody's fearful, like you're saying, right? And so,
it's the hardest thing.
Yeah. And it's super harder to be fearful when everybody's greedy. That FOMO is contagious, right?
Mm-hmm.
So that filter of the advisor to really kind of put those emotions in check, so that when you're making a decision, at least they've walked you through, okay, here are all the reasons why you're making this, right? You're comfortable. Right. Couple quick things as well. What you were talking about the penalty of getting into cash and then just never being able to get back in. Peter Lynch, one of the most successful portfolio managers in history, he's got that quote of more money has been lost. What is it? More money has been lost basically staying out of the market, waiting for the next correction, than was actually lost in the next correction, right? And so you got to be careful of that. And like I said, I'm totally guilty. I've had way too much cash for way too long in my investing career. So I have paid that price. I know it's a real one, but it's a totally understandable fear, as we've been talking about here. Lastly, I want to build off of your gardening analogy. Tell me if you want to add this into your whole gardening worldview. But it's April out here in California, and weather's great, and everybody's putting their gardens in. When you grow a garden, you just don't take all your seeds all at once and just go out and throw them into the garden, right? You plant them at the right time for each varietal of plant that you're planting, right? And so that's what you want to do here. And then you keep a part in reserve, right? That's your seed, your seed corn, your seed plantings. That's what's going to keep you going over winter, right? In case you don't get the harvest that you want, right? So, I think the way in which you deploy cash is very analogous to the way in which a prudent gardener deploys seeds.
Yeah, no, that's absolutely right. I mean, look, you plant certain vegetables and certain fruits in spring and summer. There's certain things that you plant in the winter months. There's certain things that you don't plant on a year-over-year basis because it depletes the soil. You got to rotate your crops as well. A farmer will tell you this. Because certain plants will deplete all the nutrients out of the soil. So these are all things and that apply to portfolio management. And there are seasons for everything in your portfolio. And right now, look, we're in a season right now. We're in the inflation season for the portfolio, right? So we want to own some things. So we own energy, we own defense because of Russia, Ukraine, we own some other stuff because that's the season right now. But as you said, if we get a resolution to the Russia-Ukraine event, which we will, there will be a resolution to this at some point. And what the resolution is, I have no idea, but there will be a resolution. And when that occurs, this market's going to rally, and the commodity, the defense, sectors, those you're going to want to harvest those, and then let's go plant some growth stocks, because when we plant those growth stocks, that means inflation is going to start, deflation, disinflation will happen, and that's going to benefit those companies that can grow earnings in a disinflationary environment. So again, it's just understanding the season you're in and planning accordingly.
All right. Yeah, I think we're going to be riding your gardening analogy for months and months and months on this program. All right. Well, before we wrap this up, I've got some kind of questions that have come along to me via emails or things that have happened to me in the past week that I'd love to get your thoughts on. And you mentioned earlier about, being able to have the stomach to go into an asset class when it's hated, if you've got, the technicals and the fundamental confidence that it could have a brighter future ahead of it. There are two that I want to ask you about. One actually right now is not necessarily a darling, but it's done well. And that's high yield bonds. I was looking at JNK today, which is an ETF for high yield bonds. And folks, the other name for high yield bonds is junk bonds, right? And junk bonds have been ridiculously priced over the past couple of years, where they should have the highest yields because they're the riskiest debt out there. And their yields were down in the 4% range, which historically is just valuing them as a ridiculously more safe asset than they are. And for a period of time last year, junk bond yields were lower than the rate of inflation, which is just mind-blowing, right? JNK ETF has come off a little bit, but not super a lot. And as you and I were talking about earlier, we're really beginning to see rates and yields go up, and the Fed still has a bunch of rate hikes left in its arsenal that it says it's going to deploy. How vulnerable does that class look like right now? I mean, is this the time to start thinking about shorting junk debt?
Look, shorting something that hasn't broken yet is a trade, right? So there's two ways to approach this. If you're long junk bonds, I would be very cautious about being long junk, because as I said earlier, when we get into a recession, something will crack the credit market and junk bonds will drop by 20 or 30%, and literally overnight. I mean, you'll wake up and you're going to go, what the hell just happened to my stuff? Now, remember, it's still the Tina effect. There's a bunch of people right now that are still going, well, I'm not getting anything in money markets, and inflation's 580% now, so I better go get 4% in junk bonds, because because they're not called junk, right? They're called high yield, that nice Wall Street marketing term that we all use. It's not junk, it's just high yield. Go put your money in it.
It's a premium yield product. Yeah,
exactly. It's completely safe. But when those things crack, it's going to crack fast. Now, when that crack occurs, that's going to be a buying opportunity, because the Fed's going to come in and start buying them again, just like they did in 2008. In 2020. Just be careful of it. Now, the problem, I have no problem with you shorting high yield. I think there's probably a decent opportunity. I'm not doing it yet for clients only because, it can be a position that takes time to work out, and I've got plenty of cash. So I really just don't, if you take a position shorting something, that's a bet. You've made a bet with capital, and if it goes wrong, you're going to lose money. So, there's no surefire guarantee that shorting junk bonds are going to be a play, but I think it's a reasonable trade. I don't need to do it because I've got 30% in cash right now. So I just don't really need to take on excess risk at this point just to short junk bonds. But if you want to do it, I think there's reasonable trade. Just keep a stop loss. So if that thing does, if something happens and, the Fed goes, hey, we're going back to zero rates tomorrow for whatever reason, and Russia, Ukraine resolves itself, and all of a sudden Zelensky and Putin are having, a hot bath together, that's going to cause junk bonds to run back to the moon. So, you want to make sure and close out that position pretty quick.
All right. Yeah, great advice. And two quick things we should probably define for folks. Being long a security just means you are expecting it to rise in price. Mm-hmm. Being short a security is expecting it to go down in price. And I think you're right in general, or at least this is my perception. You correct me if you think differently, but from my investing history, the long trade is something that is a process. The stocks tend to rise over time, right? If you're making a short trade, it tends to be more an event like you're talking about, where if you've got a thesis that says, hey, this company is priced too high, and I'm gonna bet the market's gonna wake up to this. Well, you could be waiting a long time. And also when you're right, it tends to be a fairly quick repricing. So it's often not like, well, I'll wait until it starts going down and then I'll jump on the bandwagon. A lot of these market corrections in a particular security tend to be very quick. So you generally often don't get that opportunity. You're either in it when that happens or you're not, right? I see you nodding and laughing as I'm saying.
No, I know. I'm kind of nodding and laughing because my wife and I just watched The Smartest Guys in the Room about the Enron trade. And, and Jim Kanos was the guy that was short Enron and nailed it and made just a ton of money on it. But you had to be in that position because when the reality woke up about the Enron scandal, it was over. I mean, the next day it was done. And within 48 hours, I mean, they're like filing bankruptcy and pushing people out to the streets. And if you haven't seen the movie, it's absolutely fascinating to understand what happened with Enron, because there are companies today that have a lot of similarities to what Enron was doing back then. Enron had some great ideas. You may not know this, but Enron had this great idea. They teamed up with Blockbuster at the time to do video on demand. Boom. If they would have succeeded in getting that to work, they would have been Netflix. Netflix wouldn't exist. It would have been Enron video on demand. That's what you would have been watching today. But it failed because they couldn't get it to work right. But they had really great ideas. And there's a lot of companies in the market today that are trading at 30 times price to sales, have a great idea. They don't make a dime on money. So make sure you know what you own.
Yeah. Well, it's interesting. So Chanos, he's probably one of the biggest spokespeople to say, hey, if you're going to short, you got to be really confident, and you really got to kind of have the deep pockets to last the period where you might be wrong until you're right. And for those who read The Big Short, know that Michael Burry, he lost a ton of money for years betting against the housing market, and got to the point near the end there where he was really desperate, and just fortunately was able to continue to raise enough capital to stay in the game to then finally be proven phenomenally right. But there were many other investors like him, both in that scenario, but also the lots of people leading up to the 2008 crash and even the dot-com crash, who took short positions and just got creamed as the market just the market can remain irrational for longer than you can remain solvent, right? So all I'm saying is if you're going to take a short position, just be aware of the dynamic that we're talking about here. All right, next question is another truly, it's one of the very, very few truly hated sectors right now. And folks, I'm going to mention it, and I'm not advising people invest in it, and you're going to have to determine your own ethics or whatnot. But I'm talking about the cannabis industry, which, is one of the very few sectors of the market that hasn't, caught on fire in the past bunch of years, and not at all really since the trillions of stimulus that were released, back following the pandemic. It's really one of the few that's been left for dead. And I saw an article this morning showing that there's new legislation in the House of Representatives to legalize it on a national basis. So there might be kind of a macro fundamental catalyst for the sector here. Lance, I'm just curious, you have an opinion one way or the other about the prospects for this sector? I'm not asking you to make a call about whether folks should invest in it or not, but anything that you might have to say about it.
It's funny, about 3 years ago, I was invited to speak at a big investor conference up in Vancouver, Canada. And this is a big conference they have every year, and they have all these money managers come in. And I was in the back of the room and was, kind of waiting. I was doing the keynote speech. And so, but they had all these other kind of fund managers that were coming up, pitching their small cap fund, their mid cap fund. And they were all touting at that time, it's like, oh, we're like, forget owning any other stocks, just own cannabis, right? So own Tilray and these other companies, because they're going to make you just a killing over the course of time. And, I was sitting in the back of the room making myself notes. I was like, short cannabis because, and the reason is that, whenever there are a bunch of fund managers that are that bullish on any sector, they typically tend to be wrong. It's always about sentiment, right?
Yes, it's the crowded side of the boat scenario.
Exactly. And so sure enough, the whole thing, to steal a term and a title, went up in smoke over the course of the next, couple of years. And those have been
second dad joke of the day.
I know. So I'm only allowed 3. So we got to the end, kind of the end, and they've been very terrible performers. And this has all been on the hope ultimately that we're going to legalize marijuana. And I think they will. Will they get it done, before midterm election? I don't know. There's a lot of stuff going on in Washington that may hold up legislation, but, eventually I think it'll get done. I think the key thing to think about though, is there's already, my wife sells liquefied natural gas. And, that's one of the things that cannabis growers use all over the country to, heat their growing barns. So, there's already a lot of people that are producing this. You've already got a lot of supply online. And when you legalize this, remember the one thing that the reason people pay an arm and a leg, literally a lot of cases, for drugs is because they're illegal. And so they're trying to get them. And this is one thing that Colorado has discovered, is that once that they made it legal, everybody started buying it illegally again so they could avoid paying the taxes. So, it's always a supply and demand game. And for these public companies, yes, I think there's certainly some upside for them because a lot of them have been beaten up. But, markets tend to take care of themselves. And once you legalize this is going to become a supply and demand game like everything else. So it's going to be important. And I was talking to a gentleman today as a good example. And we were talking about, back in 2000, we were talking about Sun Micro and Dell Computers and those type of things. And, when you go back to the early 80s, there were a bunch of computer companies. And if you happen to be the smart guy that bought Microsoft, you did great because the other 19 of them all went bankrupt. So, there's going to be a winner in the cannabis space, and I'm not smart enough to pick it out. So, just again, this is going to be one of those things that you buy small amounts of. You're going to make some money with it probably if they do legalize it. But once that happens, you've got to start trading it just like any other position in your portfolio.
All right, great. Yeah, I recently interviewed Jim Rogers, and he made the comment near the end of just, hey, disaster is not a bad. What did he say? Looking for disaster is not a bad way to invest. And what he sort of meant was, look for these sectors that have been crashed and burned and left for dead. And as I sort of look around, like I said, there aren't that many right now because we're in the everything bubble and everything has risen. But this is one of the very few that really hasn't. So anyways, just wanted to get your thoughts on it. I think it's I think you gave a great answer. And like I said, folks, I don't know much about this sector, so I don't have a horse in this race either. But
buy gummy bears.
Buy gummy, exactly. All right. Well, look, real quick, folks. One of the things that we always try to do in this channel is try to find, additional better ways to serve you guys. And so we're going to try something new next week. Is we're going to do our first live YouTube event. And for it, I'm going to have Lance come. I'm also going to have the two lead partners from New Harbor Financial, who are the other financial advisory firm that Wealthion endorses. And what we're going to do is we're going to have an hour of live Ask Anything Q&A around money for these folks. So any questions that you may have, you can come online, you can ask them live. Well, field them for Lance and the other guys, and they'll just take their best attempt at answering your questions. And for a few lucky folks, we'll actually bring you into the experience itself. We'll have the camera on you, and you'll be able to ask your question while looking Lance and the other guys in the eyes. So if that sounds of interest to you, we're going to be doing this at noon Eastern on Tuesday, April 5th. So be sure to keep your eye out on our YouTube channel then. And if you're interested, please participate live. All right, Lance, I'll give you the last closing words here, but based upon what's happened this week, what you guys are looking at, any bits of parting advice for folks today?
Thinking that basically that we're going to see, again, a little bit more pullback here over the next week or so, some sloppy trading. Mid-month tends to be pretty good for the stock market because April 15th tax returns, people get money to invest, and markets tend to perform better mid-month. The end of April tends to be weak. So, again, I think there's a reasonable possibility markets might hang in here, but the thing to watch is just watch if the market breaks those moving averages, because that is really going to be the setup potentially for a retest of lows as that occurs. So again, we'll keep talking about this every week. And since apparently this Tuesday event is 2-on-1, I got to go to the gym and train a bit. So.
All right. Well, I know you get that martial arts background, so you get a little bit of an edge up on these guys. All right. Yeah. And exactly to your point there about the moving averages and the key technicals, folks, we will be tracking those closely on this program week after week going forward. So don't worry that you got to watch the tape every day next week. We'll be wrapping it up for you in 7 days. Lance, as always, great conversation. Folks, if you continue to like this weekly market recap series, please do me a favor, hit the like button to let us know so. If you haven't already, click the subscribe button below, the red subscribe button. And if there's any ways you'd like for us to improve this series, topics you'd like us to address, etc., just let us know in the comments section. Lance, great as always. Everybody else, thanks so much for watching.
See ya.